Welcome back, everyone, to another installment of John and Jane's retirement series. This one is for Jane's August retirement account review, and I apologize for the delay. I picked up a job with my excavator and then also had a baby shower at our house this weekend, so I was left without an office to be able to work in at night, and so I am planning on getting John's article for August done here soon, and then we'll begin working on the September articles so that when the 1st of November rolls around, I can make sure that I get the October articles released earlier on in the month. And then, as I mentioned before, I plan on working on some videos that'll be a little bit more fun, a lot less dense information-wise, a lot of practical use. So anyway, without further ado, let's jump into the numbers. So as always, I am not a financial advisor. I do not claim to be one, and this article reflects my personal views and does not reflect the views of my employer. Everyone should always do their own research, and I also share a lot of positions with John and Jane in their portfolio, and I have those listed out below. And then this is a real portfolio with actual shares being traded. So I want to make it very clear this is not some practice portfolio with fake money in it. These are real trades that are happening, and that is why I include the screenshots I do. So without getting too deep into it, and again, I plan on making a video about this in the future, but John and Jane were being taken advantage of from my perspective. By their financial advisor, who was not only charging them a 1% advisory fee, but on top of that, decided to change companies, and in that process, hit them with a number of load fees that resulted in probably about $30,000 worth of losses by just switching out of one company's mutual funds to another. So the big reason why I do this is that I just like to challenge conventional thinking, and my job is, I see it, is to empower John and Jane to take advantage of their own finances and to basically produce the results that they'd probably be able to achieve similar results with a financial advisor, and in this case we can avoid the fees and give them full control over it so that it works the way they want it to. And as far as the background goes, John and Jane are both retired. John was in 2018, Jane was in 2021, and both of them are currently receiving Social Security as their only set forms of income. When it comes to the accounts that we review, they do take $1,700 a month from the taxable portfolio and $1,000 a month from John's traditional IRA, and we cover that in those articles. But at this moment, that is the only income that they receive. When it comes to other funds that they have, there are investments that they have mostly in low risk bonds, CDs, things like that I don't touch, and that's just held at local institutions, brick and mortar type of institutions. But John and Jane have made it easy because they do not have any debt. They own every thing that they have outright, and all of it is relatively new. So pretty much they just have the recurring monthly bills of property taxes, cell phones, you name it. When it comes to the traditional IRA, generate a little over $1,555 of dividend and interest income in August of 2023, which was a pretty substantial increase over the $1,135 of dividend and interest income in August of 2022. The Roth IRA generated nearly $750 in August of 2023, compared with $585 in August of 2022, so also a substantial increase in the Roth IRA. As far as the balances go in the accounts, the traditional IRA is actually up year over year by just a little over $12,000, and the Roth IRA is down about $600, so basically flat year over year. One thing that I want to reiterate is that because we do not draw funds from Jane's accounts, this includes all dividends and interest received being reinvested. So just know that in previous articles with John's account and with the taxable account, what I'll often do is I'll add back in those withdrawals just to see what a real return would have looked like had those funds not been drawn out. And in this case, the results look good, but really it's about the same because obviously with the traditional IRA, for example, that $12,000 would be basically exactly what would have been drawn out of the account had she been taking $1,000 a month. So there were two companies in Jane's retirement account that paid increased dividends or a special dividend during the month of August, and no companies in the month of August decreased their payouts. When it comes to General Mills, we already covered this in the taxable account article. We cut back the size recently of the position in General Mills to back to the lowest cost shares. So we just got rid of not necessarily high cost shares, but shares that were definitely higher cost than the ones that we kept. And then with the Royal Bank of Canada, they came in at a 2.3% increase. And my concern with the Royal Bank of Canada is that it has a significant exposure to real estate. When it comes to Canada, mortgages do not work the same way. Everything that they have is adjustable. Typically, you're looking at like a 5-5 or a 5-2-5 arm, I believe is how they categorize that, but essentially it adjusts every 5 years. They may have other adjustment periods as well, but the 30-year fixed mortgage product is not something that the Canadian financial system uses very often, if at all, that I've ever heard of. So my concern is that, with the inflation going up, interest rates going up, the Canadian real estate is already extremely expensive, and so anything to make their payments less affordable definitely presents a credit risk to the financial institutions that have those loans on their books. So, as far as General Mills goes, you can see that the position, this top image, shows the shares that are still currently held. And like I mentioned, you can see that the share, cost per share is extremely low here. But this second image below here, this shows when we sold off some of the shares. And as I mentioned, we were looking at well, this one doesn't show the cost basis because obviously this happened in October, so this won't be seen until November when I make the videos for that. But as far as the price goes, I can tell you that the cost per share was definitely in the mid to upper $50 share range, again, which is why we decided to execute at this point. And then for RBC, top image again shows the current cost basis of the remaining shares, and you can see that we sold over 50%, closer to about 60% of the shares back in September, early September, and that netted a price that was about $6 a share more than where the price is currently today. I'm not insinuating that timing or anything like that, but it was a good point in time to exit the stock. And if the share price dropped far enough, I would consider adding more shares of RBC, but it would need to be at the right price, similar to the cost per share that you see in the lot details above here. So for the August trades in the traditional IRA, there were 3 buys: Avient Corporation, Crown Castle, and then WP Carey. So Avient, several months prior, we had actually sold off some shares at, I think it was about $42 a share, and now we purchased back the same exact number at about $38 a share. It was a little bit too soon. Obviously, the stock price has continued to drop a little bit since then, but just like always, we're working the high cost basis of the position down, and as we accumulate, as the stock goes back down, when it goes back up, that's when we decide to kind of chip off some of those shares and sell them. Avient, believe it or not, at one point had a cost basis. At least some of the shares were in a cost basis in the 50 close, I think the upper 40, low $50 share range. So we've been able to continue to work that down, and now it's under $40 a share. And so that puts us obviously in a much better position than what we would have been otherwise. And then as for Crown Castle and WP Carey, just a same exact thing. Bought not too soon, but with WP Carey bought before the news hit, and then with Crown Castle's interest rates have continued to go up, that has put pressure on the stock price. And so now it recently bounced off of its 52-week lows. In fact, actually, several year lows of $90 a share. And so we're going to continue to accumulate when it makes sense. And as for the Roth IRA, a lot of action went on in the Roth IRA, a lot of small purchases taking place here in sales. So the top two are the sales of the group. Just like with Royal Bank of Canada for Toronto Dominion, reducing the size of that position. Same thing, they have exposure to residential real estate, but we will continue to hold shares of Toronto Dominion. I do believe that it's one of the better banks to hold. It's got a pretty large footprint internationally, as well as in Canada, so I like that about it. And then for TD SYNNEX Corp, this is the remaining shares. So there's CNXC that was spun off, I believe it was about a year and a half ago. And that is Concentrix. I like that company. We're going to continue to hold those shares. But for TD SYNNEX, when corporate spending goes down, especially with the recession on the horizon, that's kind of hitting Synnex's bread and butter, that they are basically getting people to buy and change and upgrade equipment. So if they're not buying that equipment, I expect to continue seeing that stock price to drop. So that's part of the reason why I decided to get rid of it when we did. There was a very large cost basis benefit on that one, because we had purchased shares at the low point during COVID. And as far as RNP goes, we made a purchase of some shares there. AMT, similar to what we saw with CCI. And then Nextera Energy, bought a little bit too soon. We've been buying in at the low $50 share range. And I think that is one of the higher quality utility companies that's available. So we're going to continue to pick up shares with them when it makes sense. But obviously the yields continue to push down the value of utility stocks pretty significantly. As far as the realized gain loss in August, no trades took place in the month of August in terms of sales. And then in the Roth IRA, we had SYNNEX Corp and then Toronto Dominion. And as I mentioned, you can see a very large benefit here with the cost basis being quite a bit smaller. And that was because these shares were purchased at the point lowest, or where the stock price was at its lowest point in like a decade during COVID. Now for the year-to-date numbers, I think here, when you look at the proceeds, this paints a pretty clear picture that there's a lot of activity that's been going on in these accounts, a lot more than what I would normally do. But given the environment of interest rates rising like they have, it has made it to where stocks are no longer the investment that they used to be, because now we can pick up low risk or what would be referred to as risk-free type of investments like CDs and bonds. So getting those and having a yield of 5.5% really takes care of the income problem that John and Jane are looking for, especially because these are usually CDs that are anywhere from about 3 to 12 months. So it's not being locked in over a long period of time, but this is what I was talking about when I say, expect to see quite a bit of cash coming into the account, and I'll cover that here shortly. And then as far as the Roth IRA, not nearly as many trades, but again, similar type of situation where a lot of proceeds being generated from the sale of shares. For the traditional IRA comparison, we eliminated AbbVie from the portfolio. I was going to go into a little bit longer talk about it, but basically what it boils down to is that of all the sectors in the investment world, the pharmaceutical industry is one of those that I am going to claim to know the least about, and would prefer to invest in something like BME, which is a closed-end fund that is for BlackRock Health Sciences Trust. That is a much better investment option than investing in a single pharmaceutical company, because the risks are just too high. If a drug gets denied, there's just way too many variables, and it's just not something that I can keep track of or have any desire, honestly, to keep track of. So eliminating AbbVie at the price that it was at, I think made a lot of sense, and we'll continue with something like BME moving forward as an alternative. We've seen substantial increases in the dividends from British, I think it's British American Tobacco and then Verizon, and in both of those cases, the increase isn't necessarily because the dividend has been raised significantly. It's because we've added quite a few shares. So in both cases, we've seen the stock price drop off pretty considerably over the last few months. And yeah, I think that BTI is a good buying opportunity. I think Verizon might have a little bit more to slip, but nonetheless, I think that Verizon is still a lot more solid than AT&T, for example, in terms of its dividend policy. And then as far as the other funds, we allocated quite a bit to SWVXX, and that's the money market that allows your funds to be liquid next day, but at the same time generating an above average yield. And then as far as August of 2023, it did include interest from one CD, so the additional income will be coming in October from the additional CD that's been added, and you'll see the additional CD in the gain-loss tables. And then for the Roth IRA comparison, we grew the position in ADC modestly, buying more as that stock price continues to come down. As with every other account that has Eaton Vance's fund in it, we've been seeing a substantial increase in the dividend income there. And then for the position of RNP, the increase in the size of that position plays significantly into how much dividend income it's producing. And then also we have NYCB. So they recently acquired New York Community Bank Corp recently acquired Flagstar Bank, and that really boosted the share price. The dividend is still the same, but now we're receiving dividends, whereas at the same time last year we were not. So for the full year comparison, one thing I really love about this is that we can see that the traditional IRA is estimated to bring in 8.2% more dividends and interest than what it was expected to do in July. So that's a pretty substantial amount. And then as far as the Roth IRA goes, 2.5% for the increase on that one. And then the previous month, it was estimated to be about 2.3%. Now, one of the reasons why you see a big jump in the traditional IRA like this is going to be because the CD income is not always factored in. CDs, especially depending on the month that the interest is earned, and how long it's there for. I've decided to just err on the side of safety of not factoring that into the income calculation at this point in time. But that's part of the reason why we're seeing such a substantial increase here, is because I'm not including this in my original estimates, and anything that's in yellow is still an estimate, so it has a chance to go up or down before the end of the year. For the account balance comparison, we already went over this pretty well. No withdrawals have been made out of the account. All dividends and interest are collected as cash and reinvested, or continue to be held as cash. So pretty straightforward on this one. Like I said, we covered this earlier in the video. And then for the 6-year traditional income, traditional IRA income, one thing I like to point out is that 2018 is kind of a year that I say, it's not indicative necessarily of how the portfolios performed, because there was a lot of money being shifted around at that point in time. But starting in 2019, continuing to see that income rise, I think is pretty awesome, and kind of goes back to what the whole game plan has been, which is to produce increasing amounts of dividend and interest income so that John and Jane can live a comfortable retirement. And then for the Roth IRA, same exact situation. I would ignore 2018 here, but you can see that that number has continued to climb pretty substantially, and is now, as compared to, 2019 or 2020, is producing basically triple the amount of dividend and interest income, which is very impressive. For the cash balance comparison, these accounts are flush with cash right now, so the combined cash balances at the last time it was taken, was $65,000 in cash. Now, of that $65,000, that does not include another $70,000 that is held in, say, money markets, CDs, anything like that. So just know that when it comes to these cash balances here, this is literally saying if it's liquid, free and clear cash, whereas all these other short-term investments could really also be included in that number as well. And then for the unrealized gain loss comparison, some of the decrease in the unrealized gains has to do with the number of positions that have been sold. So if we're selling off a position and it's making a substantial gain, that substantial gain is being realized and then is no longer unrealized, and therefore will no longer show up on this report. So when you take away investments maybe that have a lot of unrealized gains, it is possible to see some volatility in these numbers. For the traditional IRA, this is the most important table, and as well as the next one that's for the Roth IRA, because part of what I'm trying to show is that there's all kinds of different levels of volatility associated with the portfolio. And in this case, the parts that are in red show you positions that John and Jane are currently sitting at a loss on, and the ones that are in green show where they're currently sitting at a gain on. And really, it's just super important that when people tell you, hey, just follow these steps, we can show you how to be rich, it's just incredible how much of this stuff exists nowadays. but maybe they're not necessarily showing you their exact portfolio, right? Or their exact information about how they got to where they are. And frankly, those things just are so scammy. I would tell someone to be very skeptical before taking advice of anyone saying that they can show you exactly what to do and how to make money, and especially if they make it sound like you can do it within a matter of a few hours or after a couple days. So these numbers are from October 13th, and the current yield associated with these is 4.94%. And then for the Roth IRA, this one is sitting at 4.97% and was also updated on October 13th. Again, just to really hit this point home, if there are people that are telling you that they can produce results that you would otherwise never be able to do on your own, just be really skeptical of anything like that. Now for the conclusion. So, don't think I think this has already been said pretty recently, but cash balances have increased substantially, and we've eliminated or reduced certain positions. The current gain loss tables reflect sales that were made in October, at least up to October 6th, and that is why these tables are the most important, is because they actually show a depiction of what is happening now. Now, on the tax-deferred accounts like the IRAs, there will be no impact on John and Jane's taxable income, so expect to see significantly more trades as compared to their taxable account, because the taxable account, if shares are sold and there's a gain or loss associated with it, that is a reportable taxable event, and that is something that we have to be very cognizant of. For stocks with underwhelming prospects that we currently hold on to, a lot of utilities, a lot of financial institutions, I would say that we're strongly in favor of selling and investing in things like money markets, like SW, VXX, CDs, or treasuries, because the yield that can be provided by those makes a lot more sense versus the volatility that exists in the stock market world. So, again, sorry for the delay in these articles. Still getting used to this. It's definitely going to take time to get used to just this talking, beat of it, or a bit of it. And I'm hoping that in the future maybe I can do a little bit more video editing. But as of right now, not having to edit any videos definitely is more convenient. So anyone that has comments, thoughts, and suggestions, please let me know in the comments. I have been reading everything that I possibly can for those. And also, if you have anyone that you think you can share this with, it has definitely been hard going from Seeking Alpha having nearly 13,000 subscribers to now having a grand total of I think it's 20 subscribers. So anyway, it would mean a lot to me if you share this with others, and let me know if there are any questions that I can answer to help clarify anything about the portfolio. So thanks everyone. I appreciate your time and your interest in John and Jane's retirement accounts. Thanks. Bye.